Did you know in 2023, 52% of NRIs viewed Indian commercial properties as their next big investment? And with 18% showing a strong interest, it's not hard to feel like you're missing out. But why the hype? Ghulam Zia, speaking with ET, mentions the driving force behind this surge is the emergence of Global Capability Centers or GCCs and the notable advancement in India's workforce. Zia emphasized that in 2023, approximately 59 million square feet of space was absorbed and predicted a projected growth of at least 7 to 8% in 2024. Now, before you rush to call your Indian relatives, hold up. In today's video, I'll guide you through what type of properties can NRIs invest in. 7 things NRIs must know before investing in commercial property. And as always, I'll also share some bonus tips. So let's get started with some basics about which properties NRIs can invest in. So what's on the shopping list for NRIs eyeing the Indian real estate market? Well, they've got quite a few options to choose from. Before you get excited, let me tell you that NRIs can only invest in residential and commercial property, not agricultural land, farmhouses, or plantation properties. When I said few options, it meant that you could hold multiple properties and execute transactions through legal power of attorney if needed. Also, NRIs with valid Indian passports have the green light to invest both in commercial and residential properties without needing special permissions from the RBI. You can also take a screenshot of the type of properties NRIs can own in India. Now let's talk business. What types of commercial properties can NRIs invest in? First is office spaces, with sectors like retail and the IT industry booming. There's a growing demand for office spaces. NRIs can own and lease these properties to businesses. Second is industrial properties. The e-commerce sectors has sparked interest in industrial properties like warehouses and logistics hubs. NRIs can hop on board with this trend, capitalizing on the growing need for storage and distribution centers. Third is data centers. With the government pushing for localized data storage, big companies are coming to India to set up their data centers. NRIs can seize this opportunity to invest in data centers and lease them out to major players. Lastly, there are co-working spaces. Post-pandemic surge in startups and businesses led to a spike in demand for office spaces, including co-working spaces. NRIs can lease out these spaces for attractive rental incomes. There are some options you can look into, especially when you know about the PLI scheme. If you've not heard about PLI, do not worry, as I will discuss it in the very next segment. But what if you already owned a property in India and later become an NRI? Don't worry. You can still hold on to your property back home, whether it's a plantation, a cozy farmhouse, some fertile agricultural land, or even a commercial property. You're allowed to keep it under your name. Plus, you can rent the property and receive rental income regardless of when you acquired it. Just make sure you've been on the top of your Indian taxes for any rental income you earn. So if your status changes, your property ownership rights remain intact. Let's get into the next segment on how you can further optimize your investments through PLI scheme. Now, the burning question, what is PLI scheme? The PLI scheme introduced by the Indian government aims to boost manufacturing and improve the competitiveness of domestic industries in select sectors. It encourages domestic manufacturing, attracts investments, and generates employment by offering financial incentives to eligible manufacturers based on incremental production. The PLI scheme covers 14 sectors, including but not limited to electronics and technology products, pharmaceuticals and medical devices, and textiles and garments. You can pause the video and go through this list. I know you must be wondering about the connection between the PLI scheme and investing in commercial property. But first you have to hear this. The allocation for the PLI scheme has been increased for the financial year 2025, reaching 6,200 crores, a 33% rise from previous year's budgeted estimate. As of November 23, the scheme has attracted investments exceeding 1 lakh crores, leading to production and sales totaling 8.6 lakh crores. And you know what all this means? Let me explain. While the PLI scheme primarily targets manufacturing sectors, NRIs can directly benefit from the demand for commercial spaces like warehouses and office complexes, especially in strategic locations. In 2023, over 5 million square feet of warehousing space was occupied by companies in Tier 2 cities like Lucknow, Chandigarh, etc., which are emerging as central industrial corridors. Additionally, as the manufacturing sectors expand under the PLI scheme, there's an indirect positive impact on the broader economy. driving demand for commercial properties like office spaces, retail outlets, which further benefit NRIs with investments in these segments. Overall, my dear NRIs, you stand to gain significant advantages with the opportunities presented by the PLI scheme in India's commercial real estate market. But before you dive into investing in commercial property as an NRI, there are some crucial things you need to know. Let's check that. Alright, diving into commercial real estate investments, especially for NRIs, requires a bit of caution. Sure, the stakes are higher with bigger investments and less liquidity. But hey, there's that age-old belief that real estate is a rock-solid investment, right? Now, before you jump into this age-old belief, here's what you must know before making that investment. Let's first start with location. Think about it. The area you choose can make or break your returns. From how much rent you can charge to how quickly you can fill up your space, it all boils down to the location. Take cities like Mumbai, Bangalore, Hyderabad, for example. These hotspots have seen booming competition with increased property value. But here's the thing. Before you start filling out that property loan application, do your homework. Research the location you're eyeing. Check out the foot traffic, accessibility, property prices, you name it. The more you know, the better your decisions. Now on to our next part, closely linked to location, which is rental. Okay, so you have already thought about the location. Is it in a spot where lots of businesses are thriving? Is it close to busy transportation hubs or top-notch schools? These things can make your property super popular in the rental market. As for the numbers, commercial properties usually make 8 to 11% in rent. That is way more than what residential properties like houses or apartments bring in, which is usually 1.5 to 3.5%. After you deduct property taxes and maintenance costs, residential properties usually only bring in about 2 to 3% in rent. But commercial properties, they usually make around 7 to 8% in rent after all those cuts. Before signing above the dotted line on your rental agreement, get a property lawyer to ensure your rental agreement is all legal and legit. They can also assist in tenant screening and facilitate online rent collection. Not bad, right? Now moving our focus to the next crucial aspect, NRI taxation on investments in commercial property. Understanding NRI taxes can be complex, especially when it comes to investing in commercial property. If you find it confusing, let us know in the comments, and if you would like us to make a detailed video on this topic. Now, when it comes to selling a property, the duration of ownership significantly impacts taxation for NRIs. Properties held for more than 2 years are subject to LTCG tax, set at a rate of 20% with added benefit of indexation. Conversely, properties sold before the threshold incur STCG tax based on the individual's income tax slab. Additionally, surcharges, cess on income tax, if applicable, also are imposed. Moreover, if you incur a loss on the sale, you can carry it forward to offset against future profits from property sales. Also, while renting out your commercial property, remember, GST applies if annual rent exceeds 20 lakh rupees at an 18% rate. However, purchasing fully constructed or resale commercial properties are even exempt from GST. Even developers and builders can claim ITC on GST paid for raw materials used in construction. Remember this tip. If you qualify for lower tax rates or exemptions under DTAA between India and your resident country, submit documents like the tax residency certificate. Additionally, consult a tax expert to fully understand your tax obligations. Alright, you've chosen the perfect location for high rental incomes and you even got the tax game. But how do you get those profits back home? That's what the next topic is about, repatriation of funds for NRIs. NRIs can earn proceeds from commercial properties through sale profits or lease or rental income. Just remember that NRIs can only repatriate money from the sale of 2 residential properties per year, even if the funds are from NRE or FCNR accounts. But there's no such limit for commercial properties. If the property was acquired when the NRI was a resident of India, inherited or purchased using NRO account funds, they can repatriate up to $1 million annually. If the property was purchased using FCNR or NRE account, the proceeds could be repatriated, but the amount is limited to the property's purchase price, including significant renovation or remodeling expenses. As for the tip, maintain thorough documentation of property acquisition and fund utilization for smooth repatriation. If required, seek guidance from financial advisors, tax experts to comply with regulations and optimize fund transfers. Now let us get into the next topic with exit pricing and strategy in mind. When you invest in commercial properties, remember that your earnings are influenced by current market rates, and lease agreement terms with tenants. That's why factoring in this while making an exit plan is essential. Start with determining your investment horizon. Consider your future market trends, rental income, property appreciation. If you intend to sell the property later, familiarize yourself with the selling process, associated costs, and potential implications of capital gains tax. Here's a small tip. Create a detailed exit strategy before investing in commercial properties. In your exit strategy, you can include factors like achieving a target ROI, reaching a certain appreciation in property value, or any changes in the market conditions. This helps you prepare for future investment decisions and also to maximize your returns. Finally, the most important and often ignored part: legal documentation and due diligence. Before rushing into Indian real estate, NRIs must arm themselves with the right legal gear and do their due diligence. Picture this. While setting sail on a boat, you would want to check whether it is seaworthy, right? Similarly, verifying property titles, ownership, documents with a legal advisor is like checking the boat before starting your journey. You also want to ensure the property has all the necessary approvals from local authorities. Getting a no due certificate from the seller is similar to ensuring no hidden surprises await you. But wait. Just as you would inspect the safety features and emergency exits on a boat, it is essential to check the fire and safety standards of the property. Understanding who's responsible for emergencies and obtaining insurance coverage is like having life jackets and emergency flares on board. When it comes to maintenance costs and amenities, think of it as maintaining your boat and ensuring it's equipped with everything you need for a comfortable journey. Also, just like you would be cautious of promises that sound too good to be true, be careful of inflated rental promises and understand the real costs involved. Don't forget to double-check the property's legal status independently through a legal counselor to avoid any rough rides ahead. Wow, that's a lot of real estate information, right? Let's quickly recap what we've covered today. NRIs can invest in residential and commercial properties without special permission from the RBI. PLI boosts manufacturing, indirectly benefiting NRIs through increased demand for commercial spaces. Residential properties yield about 2 to 3%, while commercial properties yield around 7 to 8% after deducting taxes and maintenance costs. If you qualify for the DTAA, submit your tax residency certificate to enjoy lower tax rates. Remember, GST applies to commercial property rentals exceeding 20 lakhs annually, taxed at 18%. Lastly, always consult a legal advisor so your investments are legally sound and compliant. Before you go, please note that this video is only for educational purposes. Any information mentioned in the video is not a recommendation or endorsement. Do your own research before investing in the real estate space. That's all for today's video. I will catch you in the next one, and if you found this video helpful, don't forget to like and subscribe to Groww NRI.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.